I saw this statistic. Some top real estate sponsors, they're seeing average returns, yearly returns, on their finished projects go beyond 24%.
Wow. Yeah, that's not luck, is it?
No way. That kind of performance, it really points to serious skill, deep experience, and just knowing how to execute flawlessly.
And it immediately highlights something absolutely critical for investors: who you decide to partner with in these real estate syndications. Honestly, it might be the single most important choice you make.
More important than the property itself, even.
Arguably, yes. I mean, obviously the property, the asset, it's fundamental. But think about it, the sponsor. They're like the conductor of the whole orchestra. They're the ones making sure all the pieces work together. They decide if the investment, sings or just falls flat.
That's a great analogy. The conductor. They're the experts sorting through, hundreds of potential deals.
Easily. Doing all that exhausting analysis, the underwriting.
Just to pick maybe one or two really exceptional opportunities to bring to investors like you.
Right. And that intense filtering up front, plus the skill needed to manage the asset day in, day out. It just hammers home how central they are to whether you actually succeed with this investment.
Okay, so let's really dive deep then. This whole session is about getting under the hood of real estate syndication. And we're focusing specifically on the absolute must-know steps, the details, the insights you need for doing really thorough due diligence on these sponsors. The syndicators, the general partners, the people running the show in U.S. real estate deals.
Whether it's called a syndication or a fund, yeah, the principles apply.
And our mission here, it's pretty clear. We want to equip you, listening right now, to check out these potential partners really rigorously, confidently.
We've pulled together insights from, a whole stack of sources, covering the basics, what makes a sponsor great, the really critical red flags to watch out for.
And even the regulatory stuff, right? The legal landscape you need to be aware of.
Exactly. We're aiming to give you a shortcut, basically, help you cut through all the noise and just zero in on what actually matters when you're trying to vet these partners, because it is complex.
And it's about finding someone you can genuinely trust. Trust with your capital for, 5, 7, maybe 10 years?
That's the goal, a long-term partnership.
Okay, let's jump in. First things first, just level setting. What exactly is real estate syndication? How do the sources define it?
Okay, so at its heart, it's about pooling resources. Simple as that. You get a group of investors. They're usually called limited partners or LPs.
Right.
They combine their money to buy or maybe develop or just operate a bigger piece of real estate than they could likely handle on their own.
Right.
And the key is the LPs don't manage it directly. That job falls to the syndicator, also called the sponsor or the general partner, the GP.
So it's basically a way for individual investors like you to get access to those bigger institutional quality deals, like large apartment complexes, shopping centers, big industrial warehouses.
Exactly. The kind of assets that need serious capital and, frankly, serious management expertise. The sponsor brings that expertise, does all the, heavy lifting.
And the investors. They provide most of the cash and stay pretty passive day to day.
That's the typical structure, yes. Passive participation is a big draw for LPs. Now, besides the sponsor and the LPs, there are other players too, of course.
Like who?
Well, you've got lenders, crucial for providing the debt financing, the mortgage, and then property managers or asset managers. They're the ones on the ground, dealing with tenants, collecting rent, handling maintenance.
Sometimes the sponsor does that themselves, right, if they're vertically integrated.
Correct. Some sponsors have in-house teams for property and asset management. Others prefer to hire specialized third-party firms. Both models can work, it just depends on the sponsor's setup.
Got it. So if I'm an investor looking at this, what are the main attractions? Why choose syndication over, say, buying my own duplex or just putting money in a REIT?
Good question. The sources point to a few key benefits. Number one is probably that passive nature we mentioned.
No late night calls about leaky toilets.
Exactly. You're not the landlord dealing with those headaches. The sponsor handles it. Another big one is diversification.
How so?
Well, instead of putting all your eggs in one basket, one small property, you can spread your investment capital across several syndications. Maybe one's multifamily, another's industrial, maybe self-storage.
Different property types, different locations even?
Precisely. Different states, different economic drivers. It helps spread the risk compared to owning just one single asset.
And you mentioned access to bigger projects.
Yes, larger scale often means, potential economies of scale in operations, access to more professional management teams, and sometimes better financing terms than an individual could get.
And the potential returns. We started with that 24% plus number.
Right. If the sponsor executes their plan well, the potential for higher returns compared to, say, safer investments can be quite attractive. That's a major driver.
Okay, sounds great, but there are always risks.
Oh, absolutely. And this is critical. It's because of these risks that due diligence is so incredibly important. The main risks, well, the most obvious is losing capital. Your investment could go down if the deal underperforms.
Due to market shifts or the sponsor messing up.
Could be either or both, or just unforeseen problems with the property. That's always a possibility.
And the other big one you hear about is illiquidity.
Yes.
Yeah.
Huge point. Unlike stocks you can sell tomorrow or even a house you own outright, your money in a syndication is typically locked up for years. Usually 5 to 7 years is common, sometimes longer, based on the sponsor's business plan.
Getting it out early is tough.
Usually very difficult, often impossible without taking a significant loss, if it's allowed at all. You need to be prepared to commit that capital for the full expected term.
So potential loss of capital, illiquidity, and really depending on the sponsor to execute.
Exactly, which is why doing deep, thorough due diligence on the deal itself, yes, but especially on the sponsor isn't just, a good idea. It's absolutely essential. Your first line of defense before you write that check.
Okay, that perfectly tees up our main focus. Analyzing the sponsor's track record. Why does it matter so much? You used that conductor analogy earlier.
I really think it fits perfectly. The sponsor is orchestrating everything. They bring together the investor equity, the bank debt, the property itself, the management team, the lawyers, the contractors, everything.
And they guide it all according to their business plan.
Right, from start to finish. Their skill, their experience, their foresight, how they react when things inevitably go wrong, that's what determines the outcome, the performance, the symphony of the investment, if you will.
So if the sponsor's the conductor, their track record, that's their performance history, their repertoire.
Exactly. It's the proof. It shows you if they actually have the experience, the reliability, the skill to lead a complex investment successfully through all its phases.
What specifically can analyzing that history tell you?
Several critical things. One, reliability. Do they actually do what they say they're going to do? Do they meet or ideally beat their projections? Two, experience. Have they seen different market cycles, ups and downs? Do they know the specific property type, the specific market, the specific strategy they're proposing now?
And three,
it's your best way to spot potential red flags early, before you invest. Areas where maybe their experience is thin or where past deals didn't quite go as planned.
And the sources really emphasize looking at full cycle deals. What does that mean, and why is it the gold standard?
Okay, so a full cycle deal means the sponsor took an investment all the way from the beginning of the acquisition.
Buying the property.
Right. Through the whole operational phase, maybe that involved renovations, stabilizing occupancy, managing it day to day.
The value add part, maybe.
Could be. And then crucially, all the way to the disposition, meaning they successfully sold the property or refinanced it and returned the capital, plus profits hopefully, back to the investors.
So it's not just buying it or managing it for a bit. It's proof they can complete the entire strategy. From A to Z.
Precisely. Look, buying a property, especially when the market's hot, isn't necessarily the hardest part. The real test is managing it effectively through thick and thin, dealing with unexpected repairs, maybe a dip in the market, tenant issues.
And then actually selling it well.
Exactly. Executing that exit strategy effectively. That takes skill. Timing the market, prepping the property, negotiating, closing the deal, showing you can do that repeatedly across different deals in different market conditions. That's a really strong indicator of competence.
And when you look at those full cycle deals, you compare the actual results to the initial projections.
Yes, directly. What was the actual cash-on-cash return versus projected? What was the final IRR, the equity multiple? How close did they get? Were they consistently hitting or exceeding those targets? Or did they often fall short? That comparison tells you a lot about their underwriting accuracy and their execution ability.
Consistency sounds like a really good sign.
It absolutely is. Now, it's also interesting. Our sources mention that in commercial real estate, or CRE, unlike maybe some other investment areas like hedge funds, where small, nimble players can sometimes outperform.
Yeah.
CRE often favors the larger, more established managers, the ones with really long track records.
Why is that the case?
Well, think about the advantages they build up over time. Long-standing relationships with brokers. That means better deal flow, maybe seeing deals before they hit the open market.
Off-market deals.
Exactly. Strong relationships with lenders. That can translate to better loan terms, which is huge, especially now with higher interest rates. Plus, they've had time to build out experienced in-house teams for everything: underwriting, asset management, investor relations.
So scale and experience give them an edge, especially on bigger deals.
Often, yes. But, and this is a really important nuance, just having a track record isn't the end of the story. You have to look at the portability of that track record.
Portability, what do you mean?
I mean, is their past success relevant to this deal? Let's say a sponsor has a great track record buying and managing stabilized, boring apartment buildings in Phoenix for 10 years. Fantastic.
Yeah.
But now they're proposing a ground-up development of an industrial park in Florida. Does their Phoenix apartment experience directly translate?
Probably not entirely. Different risks, different skill sets needed.
Exactly. Or someone who made their name flipping single-family homes, quickly high IRRs, short holds. Great. But are they equipped to handle a complex, multi-year, multi-million-dollar value-add plan on a large office building?
Maybe not. The scale and complexity are totally different.
Right. So as an investor, you need to dig deeper. Make sure the sponsor's proven experience, the stuff they've actually done successfully, directly aligns with the specific asset class, the specific strategy, the leverage level, the market, everything about the deal they're offering you right now.
It's about relevant experience, not just any experience. Okay, that makes total sense. So, with that frame, let's break down other key things to evaluate in a sponsor. Experience and time in business. What else should we look for there?
You want to see folks who've been in the game for several years, ideally long enough to have weathered at least one major market downturn.
Like 2008.
Or the COVID shock. Exactly. How did their portfolio perform then? Did they protect capital? Did they face major issues? Did they have deals fail? And importantly, what did they learn from that? Experience gained in tough times is incredibly valuable. Also, look at the team's background. Are their skills complementary?
Meaning?
Like, do they have someone strong in finance, another person with deep construction or development know-how, if needed, maybe someone with legal expertise? A well-rounded leadership team is usually a good sign.
Okay. What if the number and types of properties they've managed? Is bigger always better? A huge, diverse portfolio versus a specialist?
Well, a large number of deals, or high assets under management, AUM, can suggest they have solid processes, they can scale, they can handle complexity, and variety across different property types, apartments, industrial, retail, office might show they're adaptable. But going back to portability, be a little cautious if they claim expertise everywhere but only have like 1 or 2 deals in each category. That might mean they lack deep focus in any specific area.
So could be a jack of all trades, master of none situation.
Potentially. Sometimes a sponsor who is laser focused on just one property type or even one specific city or region can be incredibly effective because their knowledge is so deep. You need to assess if their experience matches the focus needed for the deal you're considering.
And if they succeeded in different markets, different economic areas?
That's a plus. It suggests they're not just riding a hot market wave in one place, but they can actually find and execute good deals based on fundamentals wherever they operate.
Okay, now let's talk numbers, the returns they present. Metrics like cash on cash, ARR, IRR, equity multiple. Investors need to understand these, right?
Absolutely. You need to know what they measure and, just as importantly, what they don't measure. Let's break them down. Cash on cash return.
What's that?
Probably the simplest. It's the annual cash flow the property generates before taxes divided by the total cash you, the LP, invested. It basically measures the income yield you're getting while you hold the investment.
So if I invest $50K and get $4K back in distributions in year 1, that's an 8% cash-on-cash return for that year. Tells me about ongoing income.
Correct. Doesn't tell you about the final profit when it sells, just the cash flow along the way. Then there's the average annual return, or ARR.
How's that calculated?
Also pretty straightforward. You take the total profit over the entire life of the deal, so all the cash flow received plus the profit from the sale or refinance, and divide that total profit by the number of years you held the investment. Then express that as a percentage of your initial investment.
Okay, so using my example, $50K invested. Over 5 years, I get $20 in cash flow, plus $40 profit at sale. Total profit is $60K. Divide by 5 years, that's $12K average profit per year. $12K divided by my initial $50. That's a 24% ARR.
Exactly. Simple to understand, but it doesn't account for when you receive that money. $1 received in year 1 is treated the same as $1 received in year 5.
And that's where IRR comes in,
Yeah.
internal rate of return.
Precisely. IRR is generally seen as more sophisticated because it incorporates the time value of money. It looks at the timing and amount of all the cash flows, your initial investment going out negative, and all the distributions and the final payout coming back in positive. It calculates the single discount rate that makes the net present value of all those cash flows equal to 0.
Oh, okay. Maybe simpler.
Yeah. Basically, it figures out the effective annualized rate of return over the whole investment period, giving more weight to money received sooner. So a deal that pays out faster will generally have a higher IRR than one that pays the same total profit but takes longer.
Got it. Higher IRR is generally better, assuming similar risk. But you mentioned a nuance.
Yeah, some sources note that while IRR used to be the gold standard, some sponsors now might emphasize ARR more. Why? Well, projected IRRs can sometimes be easily manipulated by plugging in very optimistic sale assumptions way out in the future. ARR is less sensitive to that. The takeaway: ask for both, and really scrutinize the assumptions behind the IRR.
Okay. And the last one, equity multiple.
Also very simple and intuitive. It's just the total cash you get back, all distributions plus final sale proceeds, divided by the total cash you initially put in.
So my $50K investment, if I get back $120K total over the whole period, my equity multiple is $120K divided by $50K equals 2.4x.
Correct. A 2.4x multiple means you got your initial investment back plus another 1.4 times your investment in profit. A 2x multiple means you doubled your money. 1x means you just got your capital back, no profit.
So looking at all these together gives a fuller picture.
Exactly. High cash on cash, good current income, high equity multiple, good overall profit growth, high IRR, efficient use of capital, returns came back relatively quickly. And again, the key is not just the projections for the new deal. It's comparing the actual results on past full cycle deals across all these metrics against what the sponsor originally projected for those deals. That consistency, or lack thereof, is telling.
And we absolutely cannot evaluate performance in a vacuum. Market conditions matter hugely.
Critically important. Real estate is cyclical, always has been, always will be. A sponsor's track record must be viewed in the context of what the market was doing during those deals.
Making millions in a runaway bull market is one thing.
All right, but how did they do during the tough times, the 2008 crash, the COVID disruption? You need to ask specifically about deals that went through those periods. Did they have to do capital calls, ask investors for more money? Did they lose any properties to lenders? Did they manage to protect capital? Or did they still find ways to generate return?
That really tests their resilience and risk management.
Absolutely. And a good sponsor won't hide from those challenges. They'll be transparent. They'll explain what happened, what they learned, and crucially, how they changed their processes, maybe their underwriting, their operations, their financing structures as a result. That ability to learn and adapt is a huge green flag.
Okay, this is great context on what to evaluate. Now let's get super practical. The sources lay out a step-by-step due diligence process. Step 1. Pre-call research and shortlisting. How do you even find sponsors to begin with?
Good question. Several ways. Networking is huge. Talk to friends, colleagues, other investors who are already doing this. They might have sponsors they trust and can introduce you to.
Makes sense.
Industry conferences, seminars, local real estate investment clubs. Those are good places to meet people. Online investment groups, too. And then there are the crowdfunding platforms.
What about those?
They list a lot of deals from various sponsors. They usually do some initial screening, which is helpful. But and this is crucial, you cannot rely solely on the platform's vetting. You absolutely must do your own deep dive on the specific sponsor behind the deal. Their vetting is just a starting point.
Industry newsletters, maybe?
Yeah, those can highlight active sponsors too. The goal at this stage isn't just finding any deal, it's finding potential partners whose overall approach seems to fit what you're looking for. Maybe their property type focus, their communication style, their general philosophy.
So you build a list. Then what's the pre-call homework?
Before you even think about scheduling a call, hit their website. Dig around. Read the About Us page. How long have they actually been operating as a sponsor? What's their mission? Does it resonate? Look at the team bios. Who are the key people? What's their background? Relevant experience? Credentials? How long have they worked together? Team stability is a good sign.
What about their portfolio info?
Yeah, look at their assets under management, AUM, if they disclose it. See the types of deals they've done, the locations. Does it give you a sense of their scale, their processes? Does their past work align with the kind of investment you're interested in? Also, just pay attention to the quality of the website itself.
How it looks and feels.
Yeah. Is it professional, clear, easy to find info? Are the project photos good quality? It sounds minor, but sometimes it hints at their overall attention to detail. An outdated, clunky site might be a small yellow flag.
Any other warning signs just from the website?
Definitely be wary if they're splashing huge, unrealistic return numbers everywhere without much backup, or if it's really hard to find basic contact information. Lack of transparency, even at this stage, isn't great.
Okay, homework done. You have a short list.
Yeah.
Step 2, the sponsor call itself. You need to be prepared, right?
Absolutely. Go in with your notes from the website review and a list of specific questions. This isn't just about getting answers. It shows the sponsor you're serious, you're diligent. That helps build rapport. And during the call, listen not just to what they say, but how they say it.
Like their tone, openness.
Exactly. Are they open, willing to get into details? Or are they cagey? How responsive are they? Their communication style on this first call is often a preview of how they'll communicate once you're an investor. Do they seem transparent?
What are the absolute must-ask questions?
You have to drill down on the track record. Don't just accept a summary number. Ask about full-cycle deals. How many? Can they walk you through 1 or 2 specific examples? What were the original projections versus the actual results? Cash on cash, IRR, equity multiple, ARR.
Ask about a deal that went well and maybe one that struggled.
Yes. How did they handle the challenges on the tough one? What was the outcome for the investors in that deal? That's often more revealing than just hearing about the home runs.
And ask for references. Past investors you can talk to.
Definitely. A reputable sponsor should be willing and able to connect you with a few LPs from prior deals. Also, ask specifically about performance during downturns. 2008, COVID. Did they need capital calls? How did they manage bank relationships then?
Then shift to their experience related to the specific type of deal you might be interested in.
Right. If it's multifamily, confirm their deep recent experience in multifamily. Similar markets, similar strategies like value add versus core. Ask questions that probe their local market knowledge. What are the job trends there? Who's the competition? What are the specific regulations? They should sound like local experts, not just reading generic talking points.
And understand their team setup.
Yeah. Who exactly handles acquisitions? Asset management? Investor relations? Are they in-house? How long have the key players been there? If they use third-party property managers, who are they? How long is that relationship? A stable, experienced team, especially for asset management, is crucial for actually executing the plan after they buy the property.
Risk management approach is key too. Leverage.
Ask about it. Are they conservative with debt, or do they use high leverage? High leverage boosts potential returns, but also amps up the risk significantly, especially if interest rates rise or rents dip. How strong are their lender relationships? Can they get financing even when credit markets tighten? And ask how they stress test deals. What bad scenarios do they model? Vacancy spikes, unexpected costs, rate hikes. Do they have backup plans?
And the last big one for the call, communication and reporting. Often a pain point for investors.
Huge. You need clarity here. How often will you get reports? Monthly?
Yeah.
Quarterly? What's in those reports? Just numbers or operational updates and market commentary too. Do they have an online portal where you can access everything easily? What's the target response time if you email them a question?
Ask for a sample report.
Excellent idea. See for yourself the quality, the level of detail. Good sponsors pride themselves on proactive, transparent communication, good news or bad. Poor communication is a major frustration later on.
Okay, call done. Now, step 3, post-call evaluation and validation. Time to digest and verify.
First, look at any follow-up materials they promised to send. Did they arrive promptly? Are they professional? Consistent with the conversation? Did they actually answer all your follow-up questions thoroughly? That responsiveness and follow-through, again, it mirrors how they operate. If things are still unclear, don't hesitate to ask for another quick chat.
And now's when you call those investor references they hopefully provided.
Yes, this might be the single most important validation step. Talk to people who've actually invested with them. Don't just ask, were you happy? Ask specific questions.
Like what?
How long have you invested with them? Across how many deals? How was the communication, especially when things weren't going perfectly? Did the actual results match the projections? Were there any surprises? How were capital calls handled, if any? Crucially, would you invest with them again? Why or why not?
Listen for consistency between references.
Absolutely. And probe if you get vague answers. This is where you get the real, unvarnished story. It reinforces that point we keep making. Choosing the right sponsor is probably more important than choosing the perfect property. A great sponsor can often salvage a decent deal, but a bad sponsor can ruin even a great one.
Their execution is paramount. Okay, final part of this step. Assess the overall alignment.
Yeah, step back and think. Does their whole approach, their investment philosophy, the types of deals they do, their communication style, their fee structure, does it align with your personal goals, your risk tolerance, your timeline, your expectations? Did they do what they said they'd do during this whole diligence process? Building that trust and ensuring you're on the same page from the start is key for a good long-term relationship.
Okay, that's a solid process. Now let's flip it. What are the big flashing red flags investors need to watch out for?
The sources list several really critical ones. First up, lack of full-time commitment.
Meaning they treat it like a side job.
Exactly. If sponsoring deals isn't their primary business, if it's just a side hustle, that's a major concern. These deals are complex. They require constant attention sourcing, managing, reporting, problem solving. A part-time sponsor probably doesn't have the bandwidth to do it properly, especially when things get tough. You want someone who is fully dedicated.
Makes sense. Another huge one, no skin in the game.
This is a deal breaker for many savvy investors. You absolutely want to see the sponsor investing a meaningful amount of their own money right alongside you in the deal.
How much is meaningful?
A common rule of thumb is maybe 5% to 10% of the total equity being raised. Also, are they personally signing on any of the loan guarantees? If they have no personal financial stake, no real downside risk if the deal goes south? Well, their interests might not be perfectly aligned with yours. They might take bigger risks. As one source said, a sponsor will fight harder if they have something to lose. Skin in the game aligns interests.
Okay. What about overly optimistic projections? Seems easy to fall for.
Very common and dangerous. Be super skeptical of pro formas that just look too good to be true compared to the market or even the sponsor's own past results. It could signal inexperience or worse, intentional misrepresentation.
Specific things to look for in the numbers.
Yeah, look for things like huge rate growth assumptions right in year one without a clear, phased-in plan to justify it. Underestimated expenses, property taxes often get reassessed higher after a sale. Make sure they account for that. Underestimated maintenance, payroll, insurance costs. Unrealistic vacancy assumptions. Are they assuming 98% occupancy forever? Get real? Good sponsors use conservative numbers and explain their rationale.
Poor communication history. We keep coming back to this.
Because it's so vital. If they're slow, unresponsive, or vague during your due diligence, imagine what it'll be like when there's an actual problem with your investment. Ask those references specifically about communication. Good sponsors are transparent, proactive, timely. Bad communication is disrespectful and a huge red flag.
Unclear or excessive fee structures.
Fees are necessary. Sponsors need to get paid for their work, but transparency is key. All fees should be clearly laid out, easy to understand, in the PPM and the operating agreement. Be wary of super complex structures where it's hard to see who gets what when, or fees that seem way out of line, especially big acquisition fees that dwarf the sponsor's own contribution.
Can we quickly run through the common fees again?
Sure, you often see acquisition fee. Paid up front when they buy the property, covers their deal sourcing, underwriting effort, dead deal costs, usually 1-3% of purchase price. Disposition fee, paid when they sell, covers managing the sale process, maybe 1-2% of sale price. Property management fee, for day-to-day operations, tenant stuff, paid to the property manager, in-house or third party. Usually 3-5% of gross revenue for apartments, could be different for other types. Asset management fee, paid to the sponsor for strategic oversight, managing the manager, executing the business plan, reporting, distinct from property management, often 1-2% of equity or revenue annually. Construction management fee, for deals with big renovations or ground-up builds, usually a percentage of construction cost, maybe 5%. Development fee, for ground-up, covers pre-construction work like permits, design, maybe 3-5% of total project costs.
That feels like a lot of potential fees adding up.
It can be. And if a sponsor is vertically integrated, they might charge more of these internally. The key isn't just the number of fees, but how they interact with promote the sponsor's share of the profits in the waterfall. It's the total compensation structure you need to evaluate for fairness and alignment.
So lower fees aren't always better.
Not necessarily. That saying, you get what you pay for, can apply here. A sponsor with slightly higher fees might deliver much better net results because they have a top-tier team or better deal access. Focus on transparency, clarity, and whether the overall structure fees plus promote genuinely aligns their success with yours. Does it feel fair for the work and risk involved?
Okay. Other red flags. Lack of full-cycle deals bears repeating.
Absolutely. If they've mostly just bought stuff but haven't sold much, they haven't proven they can complete the journey and actually return capital and profits effectively.
The exit is critical.
Frequent strategy changes. Yeah, if they seem to be constantly jumping from one property type or strategy to the next hot thing, it might indicate a lack of focus or an inability to execute a consistent plan. You want focus and follow-through.
And obviously, negative reviews or legal trouble.
Huge red flag. Do your homework online. Check reviews. Consider background checks on the principals. Any pattern of serious complaints, regulatory actions, or lawsuits involving the sponsor or key team members is a major warning sign. Probably best to just walk away.
Okay, so vetting the sponsor is job one, priority one. But assuming you find a sponsor you trust, you still need to vet the specific deal they bring you, right?
Absolutely. The sponsor finds and presents the deal, but you're investing in that specific property and business plan. So yes, diligence on the deal itself is still required. That starts with the property and the market.
What should you look at there?
Dig into the details the sponsor provides about the location. What's the local economy doing? Job growth, population trends, any big new developments coming? What about the specific neighborhood, demographics, schools, crime rates? Competing properties. Is there real sustainable demand for this type of property in this location at this price point? And the physical asset itself.
Review the property condition. Reports inspections, environmental assessments. Do the sponsor's plans for repairs or renovations seem realistic? Is the budget adequate? For existing properties, look hard at the current financials. What's the rent roll look like? Occupancy history. How does it stack up against similar properties nearby? What are the local trends for rent growth and vacancy? Then you scrutinize the deal's specific financial projections.
Yes. Get into that pro forma. Are the rent growth assumptions reasonable? Occupancy projections. Are the operating expense estimates realistic? Remember, property taxes might jump. Insurance costs. Are they budgeting enough for capital expenditures, replacing roofs, HVAC systems down the line? Apply that same skepticism we talked about for unrealistic projections.
And understand the cash flow timing and the exit plan.
Definitely. When are distributions expected? Monthly? Quarterly? Only at the end. What is the specific exit strategy for this deal? Sell in year 5, refinance in year 7. What sale price are they assuming? Is that realistic based on market comps and trends? And importantly, what's the backup plan? What if plan A doesn't work out? Do they have a plan B?
And then there's the legal side of the documents for the deal itself.
Critical. You absolutely need to review, ideally with your own lawyer, the main deal documents. Usually that's the private placement memorandum or PPM and the operating agreement, sometimes called a partnership agreement.
These are the rule books.
Pretty much. They define the legal structure, LLC, LP, maybe a DST for 1031 exchanges, which impacts your liability and taxes. They detail the profit-sharing structure, the waterfall. They outline who makes decisions, your rights as an investor, any restrictions on selling your share, and crucially, they list all the potential risks.
So the PPM describes the investment, the sponsor, the risks, the terms.
And the operating agreement details the mechanics of how the entity will actually run, how profits are split, voting rights, etc. You need to understand both. Pay close attention to that risk factors section in the PPM. The sponsor has to disclose them. Do they seem to have credible plans to manage those risks?
Okay. Beyond the deal docs, you mentioned regulatory considerations. This seems complex. What do investors really need to know?
It can be complex, yes, but the basics are important. Because sponsors are raising money from others, it's considered a securities offering. They have to comply with SEC rules. Most private deals rely on exemptions from full SEC registration, usually Regulation D.
And there are two main types under Reg D, 506B and 506C. Why does that matter to me as an investor?
It matters because it affects who can invest and how the sponsor can market the deal. Let's break it down. Rule 506B. Think of this as the traditional friends and family or existing network route. Sponsors can raise unlimited money from unlimited accredited investors, PLUS, up to 35 sophisticated non-accredited investors, but no general solicitation or advertising. They can't blast it out online or advertise publicly. They need that pre-existing relationship. Rule 506C. This one allows public advertising. Sponsors can post deals online, use social media, etc. The trade-off: every single investor must be accredited, and the sponsor has to take reasonable steps to verify that status. They need proof.
Ah, okay. So if I see a deal advertised openly online, it's almost certainly a 506C, and I'll need to prove I'm accredited. If I only hear about deals from a sponsor I already know well, it's likely 506B, and maybe I could invest even if not accredited if I meet the sophisticated standard.
Exactly. It tells you a bit about their fundraising approach. And speaking of accredited, quick definition reminder.
Right. Financial test. Either $1 million net worth, excluding your house, or income over $200K single $300K joint for the last 2 years, expecting the same this year. Plus, since 2020, certain professional licenses like Series 7, 65, 82 also qualify you, regardless of income and net worth.
Perfect. And that PPM we keep mentioning, that's the cornerstone document for compliance and disclosure under these rules.
What should I really focus on in the PPM?
Honestly, read the whole thing, preferably with legal counsel if you're investing significant amounts, but pay special attention to the strategy description, the property details, the fee breakdown, how returns are projected, and the assumptions, the bios and track record of the management team, the legal structure, and definitely that detailed section on risk factors. The sponsor is legally obligated to lay out the good, the bad, and the ugly in the PPM.
And there's that bad actor rule, too.
Yes. Rule 5060. Basically, people with certain criminal convictions or regulatory sanctions related to securities fraud are disqualified from participating in these offerings. If a bad actor is involved as a key person, the sponsor could lose their SEC exemption, which is a huge problem. Good sponsors do background checks and disclose any issues. Look carefully at the bios and disclosures.
So bottom line for investors on regulations, understand accredited status, know the 506B versus 506C difference, make sure there's a comprehensive PPM, and confirm the sponsor seems aware and compliant, likely using good lawyers.
That's a great summary. You don't need to be the expert on things like state blue sky laws or the intricacies of the Investment Company Act or Investment Advisors Act exemptions. That's the sponsor's job. With their counsel, your job is to verify they are handling it properly.
And the anti-fraud rules apply no matter what, right? They can't lie or hide material facts.
Absolutely critical. They cannot make material misstatements or omissions, period. Projections need a reasonable basis. They can't mislead you about strategy, risks, fees, conflicts, or their background. This underscores why your own due diligence, comparing what they say to the documents and to reality, is so vital. It's about checking for consistency and honesty.
Okay, let's circle back quickly to the deal structure itself, the operating agreement and that waterfall concept.
Right. The operating agreement legally defines everything. The entity type, LLC, LP, sponsor duties, investor rights, and crucially, the waterfall, how the cash actually gets distributed.
Give us the simple waterfall analogy again. Buckets.
Think of tiered buckets. Cash flows in the top. When bucket #1 is full, it spills into bucket #2 and so on. The waterfall defines who gets paid, in what order, and what percentage splits apply at each tier. A common structure looks something like 1. Return of capital. Often, investors get 100% of distributable cash flow until their initial investment is fully returned. 2. Preferred return, PREF. After capital return, or sometimes alongside it, investors might get a preferred return, like maybe 8% annually on their outstanding capital before the sponsor shares in the profits beyond fees. 3. The promote split. Once the PREF hurdle is met, remaining profits are split between LPs and the sponsor. GP, maybe it's 70% LPs, 30% GP, up to a certain overall return, like a 15% IRR, and then maybe it shifts to 60-40 or 50-50 after that. That sponsor share is the promote.
Understanding the waterfall is crucial then. It tells you exactly how you get paid and how the sponsor is incentivized.
Precisely. A good waterfall aligns the sponsor's big heyday with achieving strong returns for you. Look closely at the PREF rate, the hurdles, the split percentages. The agreement also covers voting rights, usually limited for LPs, reporting rules, transfer restrictions, what happens if the sponsor defaults, all the operational rules.
Okay, wrapping up. Best practices and maybe future trends.
For investors, the best practice is simple. Be thorough. Do the work on both the sponsor and the deal. Network. Ask questions. Verify. Read the documents. Understand the risks. Insist on clear communication.
For sponsors, it's about transparency, fair structures like waterfalls, and solid execution.
Absolutely. And using good legal and financial advisors. Trend-wise, technology keeps evolving. Crowdfunding platforms make access easier. Blockchain might offer future efficiencies? Maybe. But fundamentally, staying informed about market trends, local economics, demographics, that's timeless. That's essential for identifying real opportunities and managing risks for both sponsors and investors.
So as we finish this deep dive, the main message seems incredibly clear. Investing successfully in U.S. real estate syndications or funds. It really boils down to choosing the right sponsor.
It's the linchpin. Vetting their experience, their track record, especially full-cycle deals, their team, their financials, the legal setup, watching for those red flags, all within the market context. That's the most important work you'll do.
It protects your capital and gives you the best shot at reaching your goals.
Yeah, it's way more than just finding a property with good numbers. It's about finding a partner, someone capable, trustworthy, transparent, whose interests truly align with yours for what's usually a multi-year commitment.
And best sponsors actually appreciate that scrutiny, right?
They do, because they know it builds stronger partnerships based on confidence and understanding, not just blind faith. That leads to better outcomes for everyone.
Okay, so let's leave our listeners with a final thought to chew on. Given how complex these deals are, how illiquid, how long-term, how much weight should you give to your personal comfort level with the sponsor? Their integrity, how they communicate, how you feel about their ability to handle tough times? Is that gut feeling, that sense of trust, maybe just as important or even more important than the projected IRR on the spreadsheet?
And a related question. How can you really gauge that deep level of trust and comfort before you've actually gone through a market storm or dealt with an unexpected crisis together?
Something to really think about. How much does the human element factor into your own due diligence checklist, alongside all the financial analysis?
Worth considering deeply before you commit your capital.